Welcome to PhillipCapital's Weekly Market Watch. We noticed that during the credit crisis, the US dollar strengthened substantially. However, the US dollar has been depreciating on the back of a near-zero interest rate environment and equities run out over the past 10 months. How long is the correlation between US dollar and equities going to play out in year 2010? Let us hear from Mr. Liang Shiping, investment analyst from Phillip Securities. So Shiping, how do you explain the negative correlation between the US dollar and equities for the year 2009?
One of the dominating price actions has been the negative correlation between US dollar and equity prices. What the market had observed is a weaker dollar goes together with a stronger stock market. One very simple way to look at it is that a cheaper dollar means that the US stock marked down for global investors. But if investors are to look deeper, this relationship can be based on two main reasons. One of the reasons is due to the process of deleveraging. If we look back to the global economic boom during the period 2003 to 2008, it was driven by the outflow of dollar from US to the rest of the world, giving rise to what we call excess global liquidity then. The dollar inflows were absorbed primarily in emerging market asset classes. When the credit crisis sets in together with the US consumption slump, a tightening of global liquidity occurs and investors start to deleverage rapidly away from the overseas investments. This explains the appreciation in dollar and the slump in all asset classes during the credit crisis. The second reason can be related to the familiar term called risk aversion. This is a pure psychological play on the basis that US dollar becomes the safe haven for investors when everything else goes wrong. Therefore, when fear is the dominant sentiment, money flows into safe assets such as the US Treasury and the US dollar and out of the riskier assets.
Do you think the inverse relationship between the US dollar and equities will be intact for the year 2010?
Recently, the market is starting to see a decline in the strength of the inverse correlation between equities and the US dollar. Over the last couple of weeks, there are days when the US dollar and equities move up together. In fact, the correlation weakened from a strong negative 0.94 in November last year to negative 0.26 in the first week of January. This can be attributed to upside trends in the economy and the likelihood that the Fed Reserve will begin implementing policies to boost the dollar, such as increasing the Fed fund rates. Given that the general consensus is that the recovery is here to stay, I believe that the risk aversion play on the US dollar is going to wear off in the year 2010, and this inverse relationship is likely to break down.
Do you think this is a positive sign for US equities?
Yes, it looks to be a positive sign, signaling that more money is shifting back into US equities and things are heading back to normalcy. A rising US dollar could signal that investors are positive on the outlook of the US economy rather than based on a safe haven play. So far, the US S&P 500 has rose about 2% in 2010 and the US index is up nearly 3%. In terms of valuation, the US S&P 500 seems to be fairly valuated with a forward PE ratio of 15 and a price to book ratio at slightly above 2. Although I would not consider it a cheap bargain at this point of time, US stocks certainly do not look expensive either. If we are looking back to the fundamentals, the US equities outlook still looks promising for this year itself, assuming that the ongoing recovery continues. Investors can look to unit trusts investing particularly in US equities for investment opportunities.
Thank you, Shiping. That's all we have for you today. Tune in next week for more market updates.